Welcome back. Big day for the markets. What with inflation looking like it's taming down in the US and the Indian growth numbers yesterday from IIP coming good. A great combo of good growth and lower inflation. The world is in a Goldilocks scenario and we are leading it with fresh all-time highs. But let's get to the result season ahead of us. The first of the banking results come out today, Federal Bank. And in 4 days, the merged mighty HDFC Bank will announce numbers. The US inflation numbers are indicating the Fed could be one and done in terms of hikes, and falling bond yields, or rather rising bond prices, are always positive for banks. For a preview of the quarter and the outlook for the banking sector, I have with me two experts, Vishal Goyal of UBS and Santanu Chakrabarti of BNP Paribas. Both of them are well-known banking experts. Thank you, gentlemen, for your time. Vishal, first up, let me start with what could have been a worry. Margins. Do you think that we should see margins coming in 10 to 20 basis points lower for most of the banks?
Yes, that's the expectation. Clearly driven by cost of deposit hikes. If we look at the data from RBI for May, there was a 30 basis point increase, like 35 bips actually increase in cost of term deposits, while the lending yields increase now have moderated down to more like 10 basis points.
Okay, fair enough. What's your take, Shantanu? Is this going to impact all banks equally, or will there be some winners and losers?
Right. So, Latha, as Vishal was pointing out, the incremental repricing of deposits is obviously a cost factor. And most of the floating rate increases are, of course, in the rearview mirror. But some banks have a greater defense in terms of margins, purely on account of the kind of asset mixes that they run. Say, banks like IndusInd, AU Bank come to mind, who are incrementally adding at a fairly fast clip, thanks to the cyclical reversal, fairly high yield fixed rate assets. So to that extent, they are in a better position to defend their margins. But having said all of that, for most banks, I would agree that margins are at or near peak and some moderation is to be expected this quarter onwards.
Oh, okay. Yeah, so those with high risk, high return yields or kind of assets, maybe more SME, like perhaps IndusInd, are at an advantage. Vishal, what is the view going forward? Do you think we are going to see continued pressure on margins simply because the giant HDFC Bank has to replace the maturing HDFC deposits or HDFC liabilities? So they will be hungry, and if the big boy is hungry, he pushes up costs for everyone?
So, yeah, I think that has been the expectation even for last 6 months. And but I think converse to the expectations, what we saw, that there was a fairly disciplined approach on deposit gathering by almost the entire industry. And the interesting data point which actually has come through in May is cost of fresh term deposits is very close to the cost of back book, which means it's not putting any more upward pressure, especially for private sector banks I'm referring to. It's not putting any more pressure on the overall cost of term deposits for the private sector banks, which was definitely not expected given what you just mentioned about the the need for more deposit from the merged entity. So I think my sense is incrementally, clearly there is more pressure of refinancing that would keep markets slightly higher than usual rates you would have seen in previous cycles. But I think given that there is a large part of market, which is the wholesale market, which has not been yet tapped by any of these entities, you may not see any significant pressure, for the system.
Oh, that's a very big medium-term positive if that is the case. And going by the inflation numbers in the US, it does look like perhaps there is a cap on yields. We went to 4% in the US for 1 or 2 days, and now back at 3.85 on the 10-year. Let's talk growth, Shantanu. Are you convinced that the growth pace can be good? We saw a 16% system growth last year for a few months, and now it's come down to 15. So I guess that was base effect last year. So will growth be an issue, or will it just plateau at these levels?
Right, Latha. So if you look at growth, from a demand perspective, it is very hard to raise a question mark on the growth rates, because yes, the corporate offtake has been low for a lot of the prominent banks, but with a lot of the SME ecosystem moving along, retail, especially within that unsecured demand remaining high, there's no obstacles as far as asset quality is concerned, no concerns at all regarding the credit worthiness of incremental demand. So from demand perspective, there was never too much of a question mark on growth. The only concern that the market had at one point was because deposit growth in itself was a little slow. So, and LCRs were gradually moving down for some of the larger banks. Then was there to be a supply side concern? Now look at the numbers as they have shaped up in the last month or so. Even adjusting for the fact of demonetization of 2000 rupee notes, you'll realize that definitely deposit growth has moved 150 basis points higher than what the run rate was for the best part of last year. And partly it's because there are downstream impacts of credit growth. If we have been running at a heady credit growth for the last 12 to 18 months, it is to be expected that at some point the downstream impact on deposit growth is also going to come through. And that's what you are seeing. And since the system deposit number is a much larger number than what the credit number is, 12 is enough to finance 15. And therefore, I don't see too many risks to growth either from the demand or supply side.
So it will be what, high teens for the bigger banks, for the better banks, so to speak, stronger banks?
Right. So
will it go to 20?
At a system level, if we are looking at low to mid-teens kind of number, then the larger banks should be scoring 300 to 400 basis points higher, which is what our assumptions are. Then there are one-off cases like Kotak Bank, which is scaling up a specific part of its portfolio and is therefore needs to and probably would be growing a little higher. Some of the specialized asset class banks will also be growing higher. But for most of the large prominent private banks, therefore, 18% kind of growth could be doable, 17 to 18% kind of growth for the full year.
Okay, got that. Anyway, I mean, just as an aside on the deposit issue, I'll tell you, every banking economist or even central banker will tell you every loan creates its own deposit. So this fear is more a margin fear or more a cost fear. Not really. Amount of deposits is never an issue. But Vishal, the big gain all the past, 8 quarters at least, has been credit cost falling like no tomorrow. Sara nichod diya, or is there more to be gained on credit cost?
I think, we already squeezed it 2-3 times. So it seems we should be like already ended the benign part, which is because a lot of recoveries also has helped, right? The credit cost numbers. And for maybe select banks, you might see some more decline in credit costs who could not participate, in the last 1 year in the range. But if you think about incremental next 1 to 2 years, 2 or 3 things should drive it up. Not again maybe higher than averages, but at least towards the average. One is the sheer proportion of unsecured book now in banks' balance sheet is now higher, which the credit incidence is anyway higher on that book. So that would start to add to credit cost. As the recoveries also slow down, that also will, then the gross slippage will have a bigger portion going into net slippage, and therefore the credit cost should slightly increase. There is no big structural issue right now on the corporate side, so that is why one can still be relaxed. You should see gradual increases through more from the retail side.
Okay. Credit cost. What's but your medium-term view is still good. I mean, you are talking about margins kind of getting capped, and you're talking about credit cost gains receding. What's the overall view is still positive on banking at the current prices?
Yes. Yeah, I think, absolutely. I think if you look at, again, when I say overall, you also look at 20-year history of Indian banking, right? And I'm sure you've seen that. We've never had such low leverage in last 25 years. It was only last seen in, I think, 2005 or so, if I look at the corporate leverage. Plus, I think you have rates now also starting to decline. So we are not entering into a hiking rate cycle. So that also gives you some more room, in terms of expanding credit or consume. I think we should we should remain constructive overall. You can be selective among stocks, etc. But I think sector still looks pretty benign.
Okay. Well, I know you are not allowed to talk stocks, but your your reports are running for the viewers. And I think HDFC Bank is among your buys. IndusInd is among your buys. Well, let me toss this to Shantanu. Shantanu, your buys are also running. Why are you guys keeping off PSU banks? Look at the rally of the past year. All triple-digit rally. Any one PSU bank you take, the rally is more than 100%. You're not convinced that they should enter your buy list?
So, for example, SBI is one of our preferred betas. Now, Latha, what I would like to point out is also in this quarter, SBI is one of the prime candidates for earnings surprise. I mean, just a while back, you were alluding to the fact that if on margins, you guys are somewhat lukewarm and credit costs are all done, then where is the growth coming from? Please remember that in last year's numbers, at least in the first half, there is significant mark-to-market losses in some cases and small ones in most of the cases. And the first half of the last financial year also didn't see a very high disbursement rate. So the fee traction in the first half of last year is also weaker than what you're going to see currently. So through other income also there you're going to find a little bit of earnings growth. And on that, on that theme, probably SBI is going to surprise you in the quarter. Okay. So there's no such, block, so to speak. But why doesn't make it the top pick list? Firstly, because, probably HDFC Bank, ICICI Bank, these are looking better to me. But also the fact that in something like an SBI, one has to keep in mind the long-term track record as well, apart from the, the short-term fundamentals. And therefore, whether the market at any point in time would value it purely for its current fundamentals or structural cyclicality, which is kind of endemic to the business model.
Got it. Okay, there are structural and cyclical. A very quick one-line answer only, Vishal. Do you think that there can be a continued tactical rally in PSU banks?
Possible, because as I said, we are in benign cycle. And generally in benign cycle, you would see cheaper valuation and higher risk, generally franchise doing better.
All right. Sorry, out of time. But gentlemen, it's been a pleasure speaking to both of you. Shantanu, Vishal, thank you very much for joining in. And I think there are great takeaways for a viewer as well, for an investor. SBI will be the surprise, is what BNP Paribas is saying, that it could be a 100% rise in profit or even more. With that, we wrap up on Bazaar on the positive note that we continue to be at all-time highs. Chartbusters will continue to enjoy that moment. Stay tuned.